Welcome everybody to today's webinar with Mike Ott on some of my favorite topics, which is creating non-contingent purchases with bridge loans and stuff. I'm Cindy Bishop with Cindy Bishop Worldwide, and happy to welcome all of you here. We love teaching you. Most of us are seasoned professionals, brokers, just giving back. That's what we do. Our distinguished speaker today, Mike Ott, brings a wealth of experience to the table with a background as a former public school teacher and an impressive double-digit tenure in the mortgage industry. Mike has earned a stellar reputation. His unique educational approach and unwavering commitment to excellence have endeared him both to his clients and agents alike. Mike's profound understanding of the intricate nuances of the market, coupled with his unparalleled attention to detail, make any training that he does really indispensable as a resource for you guys to make sure you stay ahead of the curve and stay a little bit in front of the people that you're serving. As a senior home loan consultant at First Heritage Mortgage, Mike is well versed in the intricacies of the industry. Additionally, his status as a highly regarded and sought after trainer with Cindy Bishop Worldwide further underscores his expertise. So please join us in extending a warm welcome to our presenter for today, the one and only Mike Ott.
Thank you, Cindy. Good morning, everybody. Thanks for joining us as we look at ways to kind of help move up buyers strategize their next move, and with a focus on the ability to purchase that next home and be able to put in a non-contingent offer. So we're going to jump right in here and kind of start with some of the challenges for the move up buyers. You know, our market has been heavily weighted as a seller's market here in the DC area for a few years now, since like the COVID time and then coming out of COVID. And we're no different than the national picture in terms of very tight and low inventory. And then you couple that with a higher interest rate environment. We've got way more demand than we do supply. So for the buyers on the buyer side, it's been very competitive. And, I put here on the bulleted list, the home sale contingency is kind of like, if you're in a competitive offer situation, a home sale contingency is the kiss of death. So, it does equate to an uncompetitive offer. And, you guys have probably seen it, waiving contingencies and bidding over ask has been, kind of a normal part of our market. Now, it's definitely not at quite the pace that it was, let's say, in 2021 and 2022. But I still see offers being made over ask, waiving contingencies, when they can and when that risk is low. But the home sales contingency has been, thorn in the side, right? Because, most sellers, they want the highest and best offer with the least amount of contingencies. So we're going to kind of talk about how to get sellers who are, the to-be sellers, get them ready, and talk about some of the financing options that might help get them in a position where they can make that non-contingent upon a sale offer. All right, so we talked about high rates, tight inventory, right? It's like, okay, if I'm a seller, I could sell quickly, but am I going to be able to find my next home? And then we're going to talk really the crux of this is there's a lack of preparation, and there's more last minute decisions for sellers, and then what they realize is that they don't have the time in front of them to maybe utilize some of the financing strategies that we're going to talk about today. And in particular, we're going to focus on utilizing the home equity line of credit, and then we're going to talk a little bit about bridge loans. So and I see this quite a bit. I'll get applications from current owners that want to sell, right? Whatever the reason, right? They're running out of space, want to get to a different county or be in a different boundaries for schools for kids and things of that nature, right? But and they kind of do it on a whim, right? And they jump to it, and no fault to you guys as real estate agents, but they they contact you and you get the house on the market and may not have all their ducks in a row. You know, and then they come to a lender like me and, you know, they want to do all this in 30 days and it's kind of unrealistic, right? Now, every borrower situation is unique. And it's kind of a no-brainer if you're sitting back and thinking, well, all right, if I got super high income and I qualify for everything, well, then I can write a non-contingent offer, right? And then worry about selling the house. That's not the majority, right? The majority of people, especially now that we've had the run-up in value, the people that bought essentially 2019 prior to, and even the people that bought the you know, in 2020 during the pandemic, we just saw value shoot up since then, right? And they were rather dramatic increases on appreciation in 2021 and 2022. A little bit of a slowdown in 2023. We've kind of leveled off, you know, some, and I think Case Schiller was talking about 4.2% appreciation. Now that, granted, that's on a national level, but a lot of our jurisdictions here in the DC area kind of fall in line with some of those numbers. So we've got the, you know, when we don't have the high income earner or the unlimited supply of cash, we have the challenges of qualifying for financing. Again, we've got higher interest rates stacked up against them, and they run into this area where, hey, maybe I don't show enough income to qualify to carry both houses so that I can make my purchase non-contingent and then sell the house afterwards. Timing and logistics and negotiations are always could be a challenge, right? Choice of home sale contingency, finding buyers that are willing to rent back to sellers, and then that big question of like, okay, if I put the house on the market and I sell, and I can't find a home to buy and get under contract in time, it's like, what's my plan B? Do I have a place to live? Do I have to go into a short-term rental? Do I have any family nearby that I could, you know, live with for a little bit? So again, everybody's scenario is unique, but these are some of the challenges that I've seen in the last couple of years. And we've talked about house hostage, right? We have a lock-in effect. You know, we've got a lot of people with 3 to 4% interest rates that don't want to sell because they don't want to make the payment on the next higher priced home, let's say at 6 and 7% rates. Is kind of where we've been. So interest rates are going to be a kind of a key to unlocking the housing market. If you come to the market updates, you know, we talk a little bit about what's moving the markets, what's the outlook for rates and things of that nature. So please do tune into that when you can and join us for that on a monthly basis. And, you know, I'm going to remain rather optimistic that we're going to, you know, see some relief in interest rates, but it's just going to take some time for some of this economic data to catch up. All right, so solution one, right? When time and circumstance permit, and we've got a lot of these people with the 3 and 4% rates also have a bunch of equity in their homes, especially if they bought 2019 or prior or early on in the pandemic. So the problem is that equity is just trapped. I call it funny money, right? It's like money that's like in the walls of the house that you can't touch, you can't access unless you qualify to borrow, you know, borrow against that equity. And a home equity line of credit is kind of solution number one. But when I say when time and circumstance permit, time is a key ingredient there. And we'll talk a little bit about this, but first and foremost, the prerequisites for this is, you know, does the borrower have enough equity to borrow in the current home? Is there enough equity to tap to put enough of a down payment to qualify for the next home? And then when and if, you know, if I can get this HELOC, A, will I qualify for it? B, how much will I get? It's, you know, C, is that going to be enough? So HELOC is a less expensive route to tapping a home's equity when you compare it to the other solution that we're going to talk about, bridge loan, right? Both help serve this purpose in bridging the gap and accessing the equity in the soon-to-be departing residents. But banks and credit unions will do these HELOCs for next to nothing. A lot of them, no closing costs, right? Now, they do come, a lot of them do come with like a 3-year prepayment penalty. And the prepayment penalty is essentially like, hey, if you borrow this money on a line of credit and then you turn around and sell your house before 36 months or 3 years, then we're going to recapture the closing costs that we would have collected from you when you opened the line of credit. That's the typical prepayment penalty, but every bank or credit union can be time, depending on the banks, credit unions, and the HELOC lenders out there. I've heard some nightmarish stories where, I've seen some where, 2-3 weeks from application to having access to the money could be as quick as that. And I've seen some where we're talking 45 days plus just to get a line of credit. So that's where the time piece comes in. And this is going to be more suited to your clients that are coming to you with this concept of, hey, we're planning on making a move and we're starting to get our ducks in a row early. We're starting to get organized and have a plan for this. When the time in front of them permits them to do this, usually the home equity line, provided there's no issues with qualifying and there's enough equity there that they can tap to put down on the next purchase. This is a really fairly inexpensive route to go. You just have to account for the time it might take to get that home equity line in place. All right, so how do they work? So it's a line of credit extended to the borrowers by the banks and credit unions on the basis of the equity position in the current home. Now, most HELOCs are just kind of like a first lien mortgage. They're usually a 25 to 30-year term, where the borrower has an initial draw period of 10 years at the beginning, where the minimum monthly payment is based off an interest-only calculation on the amount drawn. So I sometimes equate this to, think of it like the borrower is getting like a credit card based on the equity in their home. And they can take money from it and give money to it any number of times, right, during that draw period. And during that draw period, the payment for most banks and credit unions is the interest. You pay the minimum payments can be based off interest only, right? So the index that's tied to home equity lines of credit is the Wall Street prime rate. Right now, it's currently at 7.5. And then what typical banks do, depending on credit profile, debt to income ratio, the combined loan to value, they will apply a margin to that prime rate. So for example, if they're doing prime plus 0.5% and they're borrowing up to 90% combined loan to value, then they're going to pay 8%. That's 7.5 plus that 0.5% margin. Now, the prime is adjustable, right? It moves in tandem with the Federal Reserve's federal funds rate. So when the Federal Reserve moves up or down their federal funds rate, the prime rate moves in tandem. If the Fed increases rates 0.25%, well, then the prime rate is going to go up 0.25%. So this is an adjustable rate mortgage or lien, if you will. All right. So now I want to kind of walk through a scenario here to kind of like, well, how's all this math done? Right. So you take a house, the current value is $670,000. Now those owners have a current first lien mortgage with a balance of $300,000 that they still owe. Now that's 44.77, right? In decimal places. We're going to round that up to 45, and that's the loan to value of the first lien. Now the HELOC lender, the bank or the credit union, says, hey, our maximum is up to 90% of the combined loan to value based on the appraised value. So if you're at 45 loan to value in the first lien, you have another 45% of the appraised value, 670,000, right, that you would essentially have access to. So that 45% of the 670 is $301,500. Now, if we're doing that prime plus 0.5% margin, the rate is at 8% today. it's a straight interest calculation, $301,500 times 8% divided by 12 months. That's going to equate to a $2,010 monthly payment. Now, that's a pretty big payment. So the lender's also going to look at, well, what's the payment and what's your debt structure, right? What other debts are on your credit report? And then do you have the income to qualify for this? Now, before we jump to some more of that math, just kind of a visual, right? But this gold line here is that 300,000 that they owe on the first lien. And then you've got the HELOC lender here at the green line saying, hey, we'll let you do a combined loan to value up to 90. The appraised value here at the top, the house is worth 670. So the shaded gray, 45% of the equity piece, that's the $301,500 that they would have access to. And that's a good chunk, right? That could put down a pretty healthy down payment on the next house. All right, back to the math, right? Because the question becomes is, do I qualify? So I've got that $300,000 first lien, and the payment on that's $1,875 on. We know that based off that prime rate plus 0.5%, that the HELOC payment's going to be $2,010 a month. And then let's just say combination of car, credit card, whatever else is on the credit report. Let's say that's equates to $500 a month, right? And then the proposed payment on the next home with 20% down is $4,000. Because this is where the HELOC is tricky, because if I'm working with this borrower to make the purchase on the next home, they have to qualify for the housing expense on the house they're about to put on the market and sell. Plus, they have to qualify for the proposed payment on the next home. Plus the other $500 a month and what other consumer debts they have. So if we're assuming a conventional loan scenario with a maximum debt ratio of 50%, here's what the gross income to qualify must be, right? We take that 8385 total debt, right, divided by that 0.5% for the debt ratio. Well, that number is 16,770 in gross monthly income required. Now, you multiply that by 12 to get an annual, like how much do I have to make on an annual basis to be able to do this? Well, the income that's used on that particular loan file has to be around $201,240. Okay, so that's a decent sized income it's going to take for somebody to qualify for this. So that's the, that's kind of like what's, you're like, what's behind the curtain when the lenders are looking at this. It's, do they qualify to carry this current house, adding the HELOC, their already existing debts, and then if I'm the mortgage lender that's trying to help them structure the purchase, I have to have factored in that proposed payment on the next home. All right, so that's kind of the math and what we look at kind of behind the scenes. And sometimes it's too much debt, right? It's too much debt. Well, and does that mean it's like dead in the moot point? Not necessarily. Well, maybe do they qualify if they only borrow up to 80% of the combined loan to value, right? Maybe they get less in the amount of line of credit to help them qualify. So we look at all possibilities to find a way for the borrower to qualify. All right. So to wrap up the HELOC discussion, right? Advantages, disadvantages. On the advantage side, it's less expensive. You have that lower interest only payment, and that's only based on the amount drawn. It's not the total line. And it's a line, not a loan, right? You can draw only what you need to put down on the next home. So in that example, let's say they only need $200,000 for the down payment on the next house. Well, they get a line of credit for $301,500. They don't have to take all of that. They just draw the $200, and their interest only payment for the time that they carry that, which will be the time from when they close on the new home And remember, the assumption there is they qualify no problem for both houses. They close on the new home, vacate the departing residence. The departing residence gets sold, and that first lien in the home equity line get paid off for the sale of the house. Other advantages, there are some credit unions that will go up to 100% combined loan to value. Sounds great, looks great on paper, but remember, borrower has to qualify. Now, disadvantages, time, right? Could take 45 days plus for some of these banks and credit unions. They don't necessarily always move at the speed of your residential or regional lenders. Prepayment penalties. Most lenders require the line to be open for 36 months. Remember, the recoup is usually the closing costs that they would have charged you when you open it. Higher interest rates could strain the debt ratio limits. And then you've got the challenges of qualifying for the current home, about to be departing residence, plus the purchase property. Any questions on the HELOC stuff? Yeah, a chat up. Am I missing anything in the chat? Conceptually, I hope that kind of makes sense on, what the HELOC does, and it's, some of the pluses and minuses that are associated with it. So if the HELOC route's not going to work or time doesn't permit, what are my other options if I'm that move-up buyer trying to buy non-contingent and get that next house and be competitive? So solution 2 is the bridge loan, which is a temporary loan used to refinance and or purchase a home loan. Now, the bridge loan can be utilized in really 3 different ways. So the first one in the traditional sense, most people, when they think of a bridge loan, they think, all right, that's a cash out refinance on the departing residence to get the equity put down on the next home. But when you do just a bridge loan cash out refinance, you're up against the same rules for qualifying that you are if you did a home equity line of credit. You still have to qualify for the payment on the cash out bridge refinance and the proposed payment on the next house and any other debts that are on the credit report. So when you put just this isolated bridge cash out up against a HELOC, the HELOC is going to be far and away much, much less expensive. The bridge loans, and I've never candy coat this, they're an expensive piece of money to get in terms of the transaction costs. And the reason for that is most of them are a term of 6 to 8 months, right? It's a loan that the lender's giving somebody that they know is going to pay off relatively soon once that departing residence is sold. So lenders don't make money by doing 6-month loans. So what do? The charges up front are greater. The discount point fees are greater compared to any other standard mortgage. So conceptually, let's kind of walk through this with the bullet points here, right? The borrower applies. It's disclosed as a standard cash out refinance. An appraisal is obtained on the departure residence, right? No bridge loan lender is going to lend money without having an appraised value on the departing residence. Simultaneously, the borrower is approved for the purchase of their new home, right? Remember, we got to qualify them for both, or we can't do it. Contract is ratified, however, and it's not contingent on the sale of the departure home. So again, that's a scenario. What's in the background is the assumption here is the borrower qualifies for everything, both houses. Borrower closes on the bridge cash out refinance at least 1 week before closing on the purchase contract to allow time for their rescission period to take place so that the funds will be available to meet the purchase transaction by that closing. The borrower closes then on the purchase transaction, and that loan would be, in this case, standard conventional FHA, VA. Then they move out, right? Move into the new home, and full steam ahead and getting the departing residence sold. And they've got 6 months to do that, so that when the house sells, the bridge loan is paid off. That's bridge loan cash out refinance isolated, just that. Okay. Now, there are circumstances when we've got borrowers who own a home, want to sell it. They want to write an offer that's, non-contingent, and they actually already have the money. They already have the 20 to 25% down for the next home. So we are not cashing out the departing residents. We're doing 20 to 25% down on the money that they already have to purchase the next home. All right, so the borrower owns the property, may not qualify to carry both payments. The bridge loan purchase offsets mortgage with rental estimate. That's the one upside of when they have the money and they don't have to refinance or do HELOC. On the bridge loan, most lenders will do kind of a rental estimate, or they might ask a third-party real estate agent to do a rental CMA, with the idea that, hey, we can offset in the qualification debt ratio, we can offset that departing residence payment. Because what's the worst case in this scenario? They have the money, they buy the next house, and then they don't sell the house within 6 months to pay off the bridge loan, right? Or the HELOC and the existing lien on that house. Well, what we do is then we say, well, if your worst case is you convert it to a rental, you should be able to do that. So it's a little bit riskier on the lending side, right? Because there's no guarantee that it rents for that much either. But that's one nice plus on the bridge loan purchase side of things. So just like the bridge cash out, once the bridge purchase happens, right? They move into the new house, they sell to the departing residents, and then within 6 months, now they got this same 6-month bridge loan that's now on the purchase property that they have to either pay off with the proceeds from the sale of the departing residence if they can, or they have to refinance into permanent finance, conventional FHA, VA. Now, it's important to note the lender in doing this, when we do the pre-approval, we're qualifying them for the bridge and for the permanent financing that we know they're going to have to potentially refinance to within the 6-month period, provided they don't have enough of the sales proceeds to just eliminate the bridge purchase. All right, so that's flavor number 2. Flavor number 3 is you do 2 bridge loans. And if you remember what I said earlier, you got to be sitting there thinking this can't possibly be inexpensive to do, and it's not. But sometimes it's the only means to the end, right? Where now you're doing a combo. Bridge loan cash out refinance to get the equity, to then do 20-25% down and use a bridge purchase loan to acquire the next home, and then move out, sell departing residence. That pays off the bridge cash out refinance loan. Now, if there's enough proceeds that they can eliminate the bridge purchase, great. If not, same thing as we just talked about, they're going to have 6 months on that purchase bridge loan that they're going to have to refinance into permanent takeout financing. Okay. So it's kind of bridge rather than just HELOC or bridge cash out, or if they've got the money doing bridge purchase, right? So in this timeline, right, the borrower applies, do the appraisal on the departing residence, they get the cash out money 1 week before they close on the purchase, but this time they're using the bridge loan to purchase the next property, and they've got 6 months now to get that departing residence sold and either pay off or refinance the bridge loan that they used to purchase the new home, right? So it can get kind of complex. And same note as on the bridge purchase, right? we're qualifying them also in anticipation, will they qualify for that refinance that will take out finance? And if you're wondering, well, how do you do that? Do you use current market rates? Well, what we do is we're pretty conservative on that. It will take the going rate on a 30-year conventional loan right now, let's say it's 7. And then what we'll do is we'll do 1% higher than that on the qualification. So do they qualify at 8% on that end permanent loan? Again, if they do, great, right? If they don't, like I said, we have to see if is there a workaround? Do they cash out less? What's it going to take for them to qualify? All right, so some of the criteria, as I talked about, the bridge loan for the time that you hold it for however many of the 6 months you may have to make payments on it, it is an interest-only required payment as well, right? But it's also an adjustable rate mortgage tied to prime, plus or minus any margin. Now, well, I should say plus. On the bridge loans, there is no minus any margin. It's always a plus. And these rates right now are probably like 8 and 7/8, 8 and 3/4. So there's definitely a margin. Again, remember, why is that? Well, lenders make money for loans over time, and this is only a very short amount of time. 6-month balloon note must be refinanced or paid off, as we talked about. And when you're doing it as the cash out or the purchase, it is the first lien position only. 75% maximum loan to value for cash out refinances. So they really have to be in a strong equity position for this to work, right? If they're currently on their existing mortgage, if they're at 80% of the appraised value, that's not going to work. If they're at 70% on the current mortgage in terms of loan to value, well, then they only can get 5% of the appraised value, and that's probably not going to be anywhere near enough to put down in the next home. So I don't want you to think, I never want borrowers, agents, as we're talking about this, to think that it's like always a slam dunk, because the reality is that it's not. Now, so when the bridge and the equity position don't work, if you can find those banks or credit unions that go up higher and combine loan to value on HELOC, or maybe you have to hit the pause button, go through the HELOC process, get that money to move forward. Now, the bridge to purchase, most residential lenders are going to require an absolute minimum of 20% down. It's preferable if they could do 25%. So I put 75 to 80% LTV. Now, while you have the bridge loan, there's no escrow. So the borrower needs to make sure that they're paying their homeowner's insurance and their property taxes. And then bridge loan isn't for low credit scores, right? A lot of them are priced as such where you have to have a middle score amongst borrowers of 700 for anything less than $1 million. And then if you're going over $1 million, the FICO score requirement is going to jump up to a minimum of 720. So this isn't money that's just handed out. This has got to be a very, very strong, stable, in terms of income, debt to income ratio, credit score. It's got to be a very strong borrower profile. And that's pretty much the wrap on bridge loan. So, in summary, kind of what we looked at today is, hey, how do we get our to-be sellers in position to be able to make that move up by, especially when they're sitting in a home that's got some equity in it that they've gained over the last few years. The HELOC and the bridge loan give you those paths to exploring this, to help put these help put your sellers and buyers into a position where they're prepared to do this, and we're not the mistake I see is we're always putting the cart in front of the horse sometimes, and it takes sometimes I'm the lender that comes in and has to hit the pause button and say, well, wait, You know, you can't just do these things in a day or two. You gotta have some time built in for them as well. So the earlier you and your sellers have these conversations, you now can set them like, hey, I learned about bridge loans and HELOCs, and I know that this isn't something that you can just do in a couple days. So we really have to plan ahead for your pre-approval for the next purchase. And if you're doing something like a bridge loan, we have to ensure that you're going to qualify also for whatever takeout financing you might do in the end. If after you sell the departing residence, you're not just eliminating the debt of the bridge loan. Any questions, guys? Uh-oh, quiet group.